Hello, I'm Dr. Cheryl Dunn, and I'm here to demonstrate a financial accounting problem in which we deal with stock and dividend transactions. The company is called Fairly Certain, Inc., so take a look at the problem. As you can see, the company is authorized to issue 800,000 shares of common stock and 100,000 shares of preferred stock. Just because they have permission to issue those shares, though, does not mean that they actually have issued them. And in the additional information that we're given, we find out that they've actually issued 200,000 shares of common stock at $6 per share, and they've issued 20,000 shares of preferred stock at $30 per share. So the first thing we're asked to do is to make the journal entries for these two stock issuances. So we'll do the common stock issuance first. The first thing we do is take the number of shares that we issued, and we multiply times the selling price per share to get the cash received. Then we multiply the number of shares that we sold times the par value to get the amount that we're going to record as common stock, because we only put the par value into the common stock account. Any amount that we receive in addition to the par is called additional paid-in capital. And so we basically take the difference between these to get the additional paid-in capital, which is often simply called APIC. To make the journal entry then, we're going to increase cash by the 1.2 million, so we're going to debit cash for that amount. We're going to credit common stock for the 400,000 par value of that stock, and we're going to credit additional paid-in capital for that difference of 800,000. For the preferred stock, we take a similar approach. We take the 20,000 shares and we multiply this by the selling price of $30 to get the fact that we receive $600,000 in cash for those shares of preferred stock. We then take the 20,000 times the $5 par value to get the amount that we're actually going to record as preferred stock. The difference then of 500,000 is what we will record as additional paid-in capital for those preferred shares. So this was requirement number 1. Requirement number 2 asks us to calculate how much of the company's dividends that they pay are going to go to the preferred shareholders as compared to the common shareholders, assuming that the stock is non-cumulative. So that preferred stock that has a $5 par value is non-cumulative. And for that, we need to also factor in the percentage that they give us with respect to that preferred stock. So they tell us that we've issued 20,000 shares of this $5 preferred stock, and this $5 preferred stock has a 20% dividend percentage given to us. And so if we multiply that $5 par times the 20%, that tells us that we have a $1 per share dividend preference. That means that we have to pay the preferred shareholders $1 per share that they own in dividends in any given year before we can pay the common shareholders any dividends at all. Now for requirement number 2, the fact that this preferred stock is non-cumulative, that means if there are any dividends in arrears, in other words, dividends that haven't been paid from prior years, we don't have to worry about that. We can just pay the current year dividend. We don't have to make up for anything that didn't happen in prior years. Because keep in mind that a company doesn't ever have to pay dividends unless they declare a dividend. So if they haven't declared a dividend, they don't owe it to anybody. But once they declare it, that establishes a legal liability. So in this case, they're going to declare a $1 per share dividend to the preferred shareholders for the current year. And then anything left on top of that that they're paying in dividends will go to the common shareholders. In this company, they're paying $250,000 in dividends this year. And since they have 20,000 shares of preferred stock, that means they're going to pay $20,000 to the preferred shareholders, and the remaining $230,000 will go to the common stockholders. That's assuming, again, that preferred shares are non-cumulative. In requirement number 3, then, they say, okay, ignore what we did here, and instead assume that those 20,000 shares of preferred stock that we issued are cumulative preferred stock. When preferred stock is cumulative, then if there are any dividends in arrears, we have to go pay the preferred shareholders their dividends in arrears, then pay the current year, and then anything left over we will pay to the common shareholders. So in this case, there are 3 years in arrears. And so they have to first go back and pay those $20,000 per year. And so that's $60,000 that they have to pay to the preferred shareholders. And then they have to pay the current year. And that means they're going to pay a total of $80,000 to the preferred shareholders. And then the remaining of that $250,000, the remaining $170,000 will go to the common shareholders. So that's how you do calculation of dividends when we have non-cumulative preferred stock and when we have cumulative preferred stock. The journal entries for each of these would be to debit either a dividends account if the company uses one, or they can directly debit retained earnings depending on whether they use that dividends account or not. Either way, they're going to credit dividends payable, which is the liability that's established when they declare that dividend. So again, they would debit either retained earnings or dividends. If they don't use a dividends account, they can just debit retained earnings directly. If they use a dividends account, they would debit dividends, and then in their closing entries, they'll close the dividends account into retained earnings, so it will end up debiting retained earnings eventually. And then we would credit dividends payable, a liability account. So the journal entry would debit that and credit that for these 2 different amounts, depending on whether the stock was non-cumulative or cumulative. Thank you for viewing this demonstration, and I hope you found it helpful.